Good evening, everyone. Just wait for a moment or two while people finish signing on. Good evening again. I'm Nan Morrison, the CEO of the Council for Economic Education. Thank you so much for joining us in what is certainly a hectic time for so many of us. We're all eager to hear from Loretta Mester, the President and CEO of the Federal Reserve Bank of Cleveland, so I'll keep my remarks relatively brief. Our audience and our speakers tonight share a common foundation in terms of vocabulary and framework. We might not arrive at exactly the same conclusions, but we understand why. Thanks to our education, we have interpreted resources that in turn give us options. In other words, we may be stressed, but we're not hopeless. We are not without a plan. This can't be said for the children and families in disadvantaged communities. Can't be said for those in working class communities. CE works to bring the resources that we all share in economic and personal finance knowledge to all of our nation's children. Most importantly, those who do not have access to it and need it the most. We do everything necessary. Sorry, excuse me. I was just informed that my video wasn't on. I double-clicked on it accidentally. Sorry about that. At CEE, we do everything to get the job done, from creating the educational resources, providing teachers with professional development, identifying the communities who need it the most. We also create programs for kids and families throughout our country. I really apologize. I'm not sure why this continues to turn itself off. Are we good? Yes, we are. It's been a big year for CEE. Am I back on? Says on.
Looks good.
Thank you. And thanks to all of you. Even in Zoom land, after all this time, stuff still happens. It's been a big year for CE on many fronts. In fact, we have just kicked off October as Economic Education Month, thanks to the advocacy and hard work of CE national affiliates and, of course, our friends at the Federal Reserve. I'm just back from 2 events that illustrate our renewed focus and our resulting momentum. At our National Teachers Conference in Virginia just last week, we all heard firsthand about the post-pandemic difficulties that our teachers are facing: rampant burnout, discouraging distrust from communities, and deprofessionalization, diminishment of the teacher's creativity, empathy, and skill in favor of hyper-specific program rigidity. All of this was supported by data from LinkedIn chief economist Karen Kimbrough and Michael Horn, leading K-12 expert, who both keynoted for us. Listening to our constituents is still one of the most important tools we bring to these endeavors. It is the only way that we can target our educational resources and professional development to their actual needs and support them where they are. Achieving cultural sensitivity, as well as rigorous pedagogical application, is an ongoing challenge. And educators continue to tell us that we're doing it right. And trust me, as the kid of a teacher, they will also tell us when we get it wrong. All of our work and theirs would be aided by support from state and local leaders in the form of passing requirements and securing funding. And again, we have great news. We're the recipients of a big grant to build a coalition that pushes for financial education in all 50 states. We're calling it FinEd 50, and it has its own dedicated website with guidance, metrics, and touch points for these efforts, including an advocacy toolkit. Take a look. The coalition will utilize our network, our flexibility and national reach to move this education into every school and district. In fact, I'm also recently back from a panel presentation in Pennsylvania. Yep, it's been hectic where we are pushing hard on this. With this coalition in place, we can carry forward the momentum of every new success. The panel included state leaders and representatives, as well as 2 incredible educators. Their enthusiasm and focus are high. There was also Brandon Copeland, a linebacker for the Ravens, for those of us who are solely focused on baseball right now. And New York is a great place to be for that. Brandon really has walked the talk about why financial education is important, and he is deeply committed to it. If young people can't read and interpret the ecosystem of finance and money, if they have no roadmap, they have lost a key tool for navigating a better life. All of our efforts are designed to bring kids together in a welcoming, accessible, friendly environment that introduces them to the possibilities inherent in gaining this knowledge that we all share. We are on the cusp of really great things. I wanted to take a moment to thank those of you who already support us and hope that those of you who may not might consider it. I'd like to now move on to the meat of our evening. Our board chair, Rebecca Patterson, who most of you know, is the Chief Investment Strategist at Bridgewater Associates. Reciting her CV doesn't begin to capture who she is after 20 years of investment management experience at JP Morgan, Bessemer Trust, and now Bridgewater. Needless to say, Rebecca has been named one of most American bankers' most powerful women in finance for 6 consecutive years. She's also gracious, generous, interested, and a formidably knowledgeable leader. And I would say all of those things even if she wasn't my boss. She knows well what finance is about, the rewards and challenges. And that is why she is here, and we are grateful. I'd also like to introduce another board member, our speaker today, Loretta Mester. The Federal Reserve has many steady hands and minds at the wheel, and Loretta is certainly among the most competent and compassionate. The American people need perspective and context that leaders such as Loretta provide. According to former Fed Vice Chair Donald Cohen, Loretta expresses herself clearly and isn't afraid to make her views known, even when they go against received wisdom. She's open to data and studies and other information that might change her mind. Exactly what we all need. And with that, turn it over to Rebecca and Loretta.
Thank you so much, Nan. And Loretta, thank you so much for joining us this evening to talk about the economy, monetary policy, financial markets. We're so lucky to have you on our board at the Council for Economic Education. And I'm just really grateful that you've given us some time tonight to talk about what's going on in the world.
Well, thanks for having me. I really appreciate it, the opportunity. And I really love having you chair the board of CEE and working with you, Rebecca.
Well, thank you. Well, let's dive in. We've got a lot of folks on this call who are eager to hear your thoughts. So I'm going to kick off with some questions, and I'm going to make sure we have ample time during this for Q&A from the audience as well. So we'll start with our conversation and then we'll open it up more broadly. But Loretta, before we look ahead to where the economy is going, what's next for policy, I want to take a step back for a minute. We all know, everyone on this Zoom call knows that the pandemic created a huge amount, once in a lifetime amount of uncertainty. And that during the pandemic, a lot of economists, including economists at the Federal Reserve, were really grappling with how to measure the conditions as we had huge fiscal and monetary easing working through the system, supply chain challenges, people thinking about living in different places, working in different ways, and you had to navigate through that. When we look at where we are today, going back to 2021, I think there is some criticism of the Fed that it didn't see the persistence and degree of inflation soon enough. And when you think about the hundreds of really talented economists at the Fed, you think, how did they miss it? If you guys can't get it right, how on earth do we? So I know I'm starting with a bit of a tough question, but I'd love to hear, Loretta, any reflections on that period, looking back on it now. What do you think the Fed has learned? What might they do differently the next time we have a shock in this level of uncertainty?
Yeah, Rebecca, I mean, valid criticism, I would say, of the Fed. But as you point out, it really was unprecedented. And I think people forget the beginning of the pandemic, how uncertain it really was, because we've navigated as a country and as an economy better than we thought we could possibly do at the beginning. And so I think that's something to keep in mind. There was a lot of uncertainty in the beginning. And then, of course, the economy shut down. And then when the economy opened up again, demand was very high. And over that period where the economy was shut down, both fiscal and monetary policy really stepped up and did a lot because of the potentially dire consequences that everyone thought would happen. I think then when the economy opened back up, two things were true. One, demand, all that pent up demand was out there. And then there was fuel for that demand, supporting that demand in terms of the support that both monetary policy and fiscal had done. On the supply side, though, as you point out, COVID actually affected the supply side of the economy too. And at the very beginning, when things were opening up, I think many, including the business people we talked to throughout this whole period, said, yeah, there's supply chain issues, but we expect them to be resolved fairly soon. Well, as you know, and as we've experienced, that didn't happen. And so you had rolling, one part of the supply chain might have been shut down. It got a little better, but then another part of the supply chain was affected. And the continuing new variants of the virus, we basically had, lockdowns and shutdowns of the economy in various parts of the country going forward. So yes, inflation turned out to be much stronger and much more persistent than we thought it would be at the beginning. The Fed did pivot towards the end of last year, as you know, and signaled that we were going to, start really moving our policy rates up and reducing liquidity because of this inflation problem. And so the good thing about this is, and the way I put it in perspective is, there was a lot of uncertainty. The Fed did pivot, I think, appropriately to a much, more deliberate retreating on that accommodation. And, I think we made the pivot. And so now we're in that, it's not like we missed it and there all is lost. We're in the job now of sort of taking that liquidity away to get inflation under control. And that's what we're experiencing now. So again, yes, we did miss it. Yes, there's a lot of looking at what that episode means for going forward, so that we learn from, what could be called mistake, not noticing. But, hindsight is very good. In the midst of doing it, we have to make policy in real time. And, perhaps we were a little bit too thinking that things wouldn't persist on the supply side and that we could look through some of those supply shocks, and that just did not turn out to be what happened.
So you mentioned looking at things in real time. So let's get real time. Let's go to today. And when we think about the drivers of inflation today, we are seeing some disinflationary pressure coming back, especially in the goods sector, things like used autos, et cetera. And then there's other parts of the inflation picture that look like they could be stickier, higher for quite a bit longer, and make the job for the Federal Reserve even more challenging. And I think the one I'd like to focus on for a minute is wage inflation. Mm-hmm. As we saw consumers, the economy's reopening, consumers moving from goods to services being more labor intensive, relatively speaking, and you just don't have enough people who want to come back and do those jobs, whether it's because of COVID or something else. And so we're having to pay up to get those people we need into the labor market. And so I sit back and think, okay, how could wage inflation come back down? Obviously, if the economy slows enough, companies start laying off workers, we could see the unemployment rate rise. That would reduce wage inflation pressure. But there's also more benign ways that wouldn't require millions of people to be out of work. You could see the labor supply improve. That could reduce wage pressure. Or one thing that's been so interesting about the pandemic, and Loretta, you said unprecedented, this feels pretty unprecedented, the number of job openings. We have seen the latest data come down a little bit, but we still have something like 1.7 jobs available for every unemployed worker, which is multiples higher than it was before the pandemic. So as we think about how do you get wage inflation down, because that'll be part of the challenge of meeting your target, do you have any thoughts on which of these three forces, unemployment rate going up, labor supply improving, vacancies closing, which of those will dominate? Or at the end of the day, it doesn't really matter. The point is you've just got to get the labor market less tight?
Yeah, I mean, you point out a lot of good points, Rebecca. So you're exactly right. When the inflation started moving up, it was concentrated in those goods prices that we saw and things directly related to the pandemic in some sense. What has happened over time, though, is because policy has been, there's a lot of liquidity out there and a lot of demand out there, you've seen, core inflation start moving up. So core inflation, which is take out, oil prices, energy prices, take out food prices, not because they don't matter, but because core inflation is much more broad across, categories, that's moved up. And so part of the driver of that is what's happening in the labor market. You're exactly right. How does that come back down? How do we get wages to come back down to a level consistent with 2% inflation, which is what we're aiming to get inflation to? It's going to be some cooling off in the labor market. I do believe that we're going to see unemployment, unfortunately, go up a little bit, but because demand for labor is so high, as evidenced by those openings, right? You could have openings come down without much increase or as big an increase in the unemployment rate and get the labor market into better balance. Wage inflation would come back down and move back consistent to a level that's consistent with 2% inflation without the kind of increase in unemployment that we might have seen in other cycles. Again, because the demand for labor has been so high during this episode. And you're exactly right. A lot of it is on the service side of the economy. And so that's going to be the mechanism. In terms of labor force participation, I mean, the last employment report, and we'll get another one tomorrow, but the last one, we saw an increase in participation. But frankly, when you look at the numbers in terms of what they call prime age participation, I don't like that term at all because I'm not in that. I'm working, but I'm not prime age anymore. But in any case, I'm older. But that's basically back to where we would expect it to be given the trend of aging of the population. So what happened during the pandemic is a lot of people sped up their retirement and left the labor force. Typically, once you start taking Social Security, you don't come back into the labor force. Now, this time could be different, but I don't think we can count on a big surge in participation rates. We'll see some, but I don't think the supply is going to adjust that much. And the other thing, of course, is immigration is still low. It was low before the pandemic, had moved down. The pandemic, of course, we shut the borders to protect our health. We didn't want people coming in. It hasn't picked back up again. So that source of labor supply isn't there either. So I think it's going to be the adjustment on the unemployment rate and the coming down of demand that'll get the labor market into better balance. And that will be supportive of getting inflation on that sustainable downward path to 2%.
And it feels like right now, not that it's ever easy, so I don't want this to come out the wrong way, but the Fed's decision is not about the direction, maybe it's about the degree, but the job market is so strong and inflation is so far above target still that of course you're going to keep hiking. But let's, a year from now, if the labor market is starting to soften and you're seeing more people lose their jobs, which unfortunately will probably be part of what happens, it needs to happen, and inflation's coming down, but maybe we're not below 3% yet, then it feels like the Fed's decision is going to be a lot more challenging, and potentially it'll become not internally, but external pressure, maybe more political. So, are you having conversations within the Fed looking ahead about how you're going to balance the strong labor market part of the mandate versus inflation as these dynamics start becoming more equal and a little more challenging in terms of how far do you go?
Right now we're really focused on the inflation part of the mandate because inflation is so high, it's been very persistent, and the labor market is still very strong. So really we have to be singularly focused on that. And the way I look at it is there's no trade-off here between both parts of our mandate. If we don't get inflation on a sustainable path back to 2% and back to price stability, we're not going to be able to have a healthy labor market over time. And so this is really job one, is we've got to get inflation down if we want to support, right, the labor markets going forward. So we're not at that point where that's an issue with us. Granted, I'm hoping very much so that we get to that point, because that'll mean that we've seen very compelling evidence that inflation is moving back down to 2%. But right now, right, the focus is squarely on using our tools to get inflation on that sustainable downward path to 2%.
And when you said you're using your tools, let's talk about that for a second. So the main tool you're using is interest rates. And we've seen very large increases this year, the fastest rate of increases from the Fed in decades. But you also have another tool that you're using in a more aggressive way this cycle, which is we all call it quantitative tightening. You all probably prefer balance sheet runoff. Either way, the pace of the balance sheet runoff is twice as fast as what we saw in 2018. Now, you don't have much of a sample size with what we call quantitative tightening or QT. How do you think about the two of them together? And for someone like me looking from the outside, how do I know if QT is working? Are there markers that the Fed is watching to say, oh yeah, this is acting the way we expected? Without much sample size, how do you know you're getting what you want from the QT? Can you disaggregate it from the rates, or is it's just too hard to parse it?
Yeah, so that's a great question, Rebecca. So, right, our main policy tool, you're right, our active policy tool is the Fed funds rate, so our interest rate tool. The balance sheet, what we learned in the last episode is, we were very, I would say, cautious when we did the first, because it was new, right? We had built up during the financial crisis, the size of the balance sheet. We wanted to move it down. We learned in that sort of what was important. And one of the big things we learned and sort of proved itself out is you have to communicate ahead of time what you're going to do with the balance sheet. And then as long as, you kind of put out a plan and get it very well, socialized, then you can let that run in the background. And that's kind of what we did this time. We could speed it up for two reasons. One, the balance sheet was much larger this time, so there was more to run off. But also, right, we had learned that this communication of putting out a plan, socializing it, actually helped it run pretty smoothly. And so that's the approach we followed this time. And so we can run it off faster without it having disruption in the markets. And we've seen that so far. It's worked fairly smoothly. Now, it is another way of removing liquidity, right, from the economy. So it's supportive of what we're doing with the interest rates. There's a lot of studies out there about, what's the trade-off, what's the equivalent with, the funds rate. And at the pace we're going, the estimates that I've seen are, between, about 50 basis points over time. But again, we don't really need to have that kind of precision. What we're doing with the funds rate is we move the funds rate up, at the level that we think is going to be enough to get inflation back down to 2%. And then we look at really what's happening in the economy. That informs our view of where inflation is, where it's going. And then we calibrate to that with the balance sheet continuing to run off as it is. So again, we're sort of using what's happening in the economy to inform our outlook. And then that helps us calibrate our Fed funds rate in order to get inflation back down. And so that's been what sort of the process has been. But you're right, they're both working in the same direction in terms of, moderating demand to get the imbalances that currently exist between demand and supply back into better balance.
Thank you. No, that's helpful. That's helpful to hear how you're thinking about it. And you mentioned, you're looking at how conditions are changing the economy as you think about policy going forward. I want to come back to how this feeds through to the financial markets. But before I do that, just a little bit on how you process economic conditions. Obviously, the Fed uses a lot of sophisticated models. They take in a lot of quantitative data. I think just over the last 5-10 years, you've seen so many great indices that have been created by the different regional Fed banks to measure inflation pressure, to measure wages, the GDP now. I find those incredibly helpful tools that the Fed's created, and it kind of gives you a window into how you're looking at things. But I also know that you speak to communities and businesses, people on the ground to get a qualitative sense, and that gets pulled into the Beige Book. I wonder if you could just spend a minute as you're preparing for the next FOMC and you're trying to get the best read you can on how tightening is feeding through, what the data is telling you. How do you put the qualitative and quantitative together?
Yeah, Rebecca, great points, because we do a lot of outreach to the constituents in our district, including business people, of course, but also community development people, right? The consumer side, the labor side, because that information is always valuable. But during a period where we haven't lived through this before, it's incredibly important. And that informs the outlook. So you're right. We have a lot of models. We have a lot of indices. We have a Center for Inflation Research at the Cleveland Fed. We put together a lot of the underlying inflation measures that I'm sure you use. And all that is incredibly valuable. But I can't tell you, I can't overstate how valuable that real touch point with Main Street, understanding what people are going through. And that's why, when people talk about, well, there's going to be some pain to bringing demand down, no doubt. But people today are in a lot of pain with the high inflation, right? They're really suffering, and especially the lower income part of the consumer side, the household side, and small businesses, because they're spending a lot more for just the essentials that we see, energy prices, gasoline prices, food prices. And unfortunately, some of those items, shelter, they're the ones that have seen the highest inflation rate. So, when you talk about, why is this job one for the Fed to get inflation down? It really is precisely because it's really hurting a lot of people. And if we want to get back to healthy conditions, this is something we have to do. But we use all that information to help us formulate an outlook for inflation, for labor markets, for the overall economy. And then that helps inform our policy decisions. But of course, we know that there's uncertainty out there. A lot of things can happen that aren't going to be exactly what you expect them to. And we have to sort of make sure that we're incorporating those risks and then taking this risk management perspective of how we're setting policy. So right now, the risks are inflation. Inflation is the big risk. We've got to get it back down. And we're doing what we need to do with interest rates to do that.
Some of your colleagues, Loretta, are starting to talk in the public forum about 50 or 75 at the next meeting. Should the pace of hikes start to slow down a little bit? We are seeing some measures of inflation expectations, some measures of inflation start to moderate, albeit at the margin. And as you're thinking about the upcoming Fed meeting and meetings, how are you thinking about the pace and just general thoughts on the economy? This is the straight ahead question for you tonight, and you can hit it head on, or you can be pivoting around it as you wish.
Right. No, I mean, the pace, that is what financial market participants always want to know. What are you going to do? Like, what the next thing? The way I approach it is, look, I think the best thing to look at is our September FOMC meeting. We put out new projections, the summary of economic projections. And if you look at those, right, the median path has the funds rate going up more and then holding there all next year, right? We don't have a rate increase in that median among the participants. My own path is a little bit higher than the median because I see more persistence in the inflation path. Right. But we're gearing those policy decisions to what we see in the economy and what we project for the economy. So, that's kind of what the path is. So inflation, very high, very persistent so far. We take all the information we have, going into the meeting, we listen to everyone around that table, and then we come up with what we think is the appropriate choice at that meeting. So I'm not going to give you a number today, but my own view is we have more work to do. We have to bring interest rates back, up to a level that'll get inflation on that 2% path. And I have not seen the compelling evidence that I need to see, right, that would suggest that we can, start reducing the pace at which we're going. So, we're in this, we're in it for a little while longer. And then we're going to have to just make sure that inflation is on that downward path. and we'll adjust as appropriate depending on what happens in the economy.
Right. And one thing that we haven't touched on yet is how policy feeds into financial markets, and then the financial markets feeds into your thinking, through the wealth channel, confidence, and then eventually activity, both domestic financial conditions, but then also external financial conditions. I mean, a few weeks ago, we saw some really once in a lifetime volatility in the UK government bond market, in the UK currency. Now, that wasn't just monetary policy. It was a fiscal easing decision that surprised market participants. I think probably created some fears about debt issuance, bond supply, how the Bank of England would have to react. But as we think about financial conditions, both home and abroad, how do you pull that into your thinking?
Well, so the mechanism through which monetary policy affects the real side of the economy, right, is through financial conditions broadly defined. So I want to distinguish that from market functioning. Okay, so the way I viewed what was happening, as you pointed out in the United Kingdom, that the reason that the Bank of England had to step in and start buying gilt is because there was real market functioning issues there. And then that was about financial stability issues. That wasn't about monetary policy. So the mechanism through which monetary policy affects the economy is through that tightening of financial conditions. I have not seen any evidence that markets aren't working in the US. Markets are working. Yes, financial conditions are tightening, but that's the mechanism through which demand is going to moderate. And it's through precisely what you said. We're going to see the wealth effects, right, through financial markets, the stock market, et cetera, bringing those demand down or moderating demand to get better balance there. So I distinguish the two. Now, in terms of, do we take into account what's happening abroad for our own monetary policy? Yes, to the extent that it has implications for the US economy, right? So of course, what happens to the value of the dollar, that's one of the financial conditions, right, that informs our outlook. Right, but we don't target that per se. That's just one of the conditions. And the mechanism, of course, is through trade. It affects our trade, and therefore it affects our economy. And then the financial markets, functioning and the interlinkages there. But again, the lens that we always take is, what are the implications for the US economy? Because our mandate is about the US economy.
Great, thank you. I'm keeping an eye on time, and I promised we'd leave a lot of time for questions from the audience here, and I've already gotten several come in. Before I turn to questions, I'm going to moderator's privilege, one last one from me. And Loretta, before we get into the broader questions, I do want to anchor back to the Council for Economic Education for a minute. And I think about what we've been living through these last few years, the pandemic shock, a very short but pretty scary recession, incredible fiscal and monetary responses, inflation that we haven't seen since the 1970s, 80s. It to me, and then people going through, as you said, some hardship with their real disposable incomes really strained. And so I think, gosh, if this isn't a time for people everywhere to realize the importance of making sure students are taught the basics of economics and finance so they can understand what's going on and plan around it and have the best lives they can, I don't know what else is going to wake people up, and whether it's state legislatures or whoever. And anyway, I'm talking my book here a little bit, but look, you've dedicated your career to economics, to understanding the economy. I'd love just to hear in your words, why do you think it's so important for students to have a course, to have this foundation in economic and personal finance?
Yeah, I mean, Rebecca, you said it, right? In order to navigate, right, the conditions that are out there at the moment, but also in the future, and prepare yourself for the future, you have to understand the basics of economic and finance now. If you want to, we want to maintain our standards of living and grow our standards of living. I don't see how you can do that if you don't understand the basics of economics and finance. And that's why CEE is so great. It's working with students, right, throughout, right, their from the youngest to the oldest to make sure that they have the understanding of economics. The other thing I would point to is, even if you're not an expert, right, you want to make sure that you understand enough so you can hold your policymakers like me and legislators accountable for decisions they're making that affect your lives, and economics affects your life. So you've got to, have some knowledge so you can say, I prefer this policymaker because I prefer his policies or her policies to that policymaker and that person running for office. So again, you're a better citizen if you understand the economy. You're able to make informed decisions about your own investments, in education and how better to finance it. There's a lot of research that says that if you do have economics and financial courses when you're in grammar school and then high school, you actually are better able to navigate college financing than if you don't. So there's a lot of benefits that accrue to your own personal life, but also I think for the whole country, because more informed citizens, make for a healthier economy and make for a better country.
I couldn't agree more, but thank you for sharing how you see it. As promised, I do now want to go to Q&A, and we have a number of great questions. And I was going to start with one that came in from Harold about real interest rates. So I think, Loretta, you've commented on this. I know other members of the Fed have as well. When you think about interest rates, we're talking about policy rates a lot in nominal terms and what the dot plot is pricing in, et cetera. Do you have any thoughts you'd share about where you'd like to see real interest rates along the curve?
Yeah, so real interest rates, of course, are interest rates that are adjusted for expected inflation. And in order to get inflation on the sustainable downward path to 2%, we need to have real interest rates positive. Okay, they're starting to move close to positive in various parts of the yield curve, but we're going to need to have positive real interest rates, so adjusted for inflation expectations, and hold them there for a time in order to get inflation back down. So, I think early on there was, talk when when the funds rate was nominally still below 2.5, there was some discussion like, well, we have to just get up to 2.5 because that's the long run Fed funds rate. That's the long run neutral rate only when inflation is at our goal of 2%. That isn't true today. Expectations of inflation are still elevated. And so we're going to have to go beyond that, which is why if you look at that dot plot, right, interest rates go up between 4.5% and 5% next year, according to that path. But we'll see what's necessary to get inflation down.
And one of the things I find personally challenging today is which inflation expectations to look at. You have consumer surveys like the University of Michigan survey, you have the Fed's own survey of professional forecasters, you have different Fed indices, you have market-based inflation expectations. Do you just pull them together and get an aggregate picture, or are there one or a few of them that you think are more important to anchor to?
So I like to look at a variety of the measures. I look at the survey measures, and I do look at the market expectations. I probably put a little more weight on the survey measures. And I'm going to plug the Cleveland Fed because we're doing some innovative work on really looking at inflation expectations of consumers. We have an indirect and consumer measure of inflation expectations that's been helpful to me. Comes out weekly, so you can really see the changes in them. But it's important to look at a variety of measures, especially in times like this where there's a lot of uncertainty out there. It's also important to look at the dispersion in the survey measures across respondents. And what you see there is, there has been some downward shift in longer term inflation expectations, which is very welcome. But there's also a lot of dispersion there. And that leaves me thinking that we've got to do all we can to anchor those inflation expectations. And some people ask, well, why do you care about that? The reason you care about that is because if people and businesses start believing that inflation is going to remain high, they're going to start basing decisions on those high inflation rates. And then that actually reinforces the high inflation we have, making it that much harder to bring inflation down. Inflation then becomes what we say is embedded in the economy and really affecting decisions. So again, if you're taking a risk management approach, you've got to get those inflation expectations anchored at 2%. And that means we have to bring interest rates up higher than they currently are.
And I think you just, at least in part, answered another question from someone named Jake here with us, which was about what are the dangers of embedded inflation. And one thing I think about, and I get this question from some of my clients, where does inflation settle? And obviously the Fed is very clear, we want 2%.
Right.
But as inflation comes down, if it gets down to 3 or 2.9, how big does it matter? I mean, obviously you can't say, sure, 3 would be fine. You can't say that because that would affect expectations and wouldn't be very helpful. But let me change the question. And if inflation were to settle at a higher rate, what's the danger of that? And I guess what you're saying, Loretta, is that if it's embedded, it affects a lot of decisions. Are there other dangers of inflation that's embedded at a higher rate that you would highlight?
I mean, think about it this way. I think partly what happened in the United Kingdom last week was people started questioning the credibility of the institutions, right? That's why it's very important. Like we said that we measure inflation at 2%, right? PC inflation is our goal. So it's important that we stick to that commitment and bring inflation down. If we started saying, oh, well, maybe it's okay if it's higher, why would people believe that the Fed really is on the job to keep prices stable? And so you end up in a situation where we're not going to be credible. People are going to start building in other things. They're not going to believe that it'll stay at 3%. What's to say like, oh, well, the Fed will let it go up to 4%. So, we have a goal. We did a lot of research leading up to when we first set the 2% goal, right? Saying that was basically the trade-offs between, not everything's indexed, we got to do trade-offs. 2% was the goal. And now we're on a path of bringing it back down to 2%. So we don't quit until we get inflation back down to 2%.
That is crystal clear. Thank you. And I hear what you're saying on slippery slope. If you settled for 3, why couldn't you settle later for 4? We have another question from Ron. We've been talking, Loretta, mainly about cyclical factors driving the view. There's also some interesting structural factors, some which are kind of at inflection points. You think about the climate transition and how that process could be inflationary at the margin. And certainly, the pandemic and now the war in Ukraine, both of those things creating questions around reshoring, nearshoring that also could be inflationary at the margin as supply chains shift and people focus more on resilience than lowest cost or purely focusing on lowest cost. Are you thinking about some of those structural inflationary issues as well? How is that discussion happening within the Fed? And the question from Ron was specifically with supply chains, but I'd be curious either on a narrow or a broader basis about structural inflation drivers.
Yeah, I think there's a lot of uncertainty about some of those things, like the reshoring that'll happen. Those aren't necessarily inflationary. That might change the price level for a time and relative prices. But in terms of ongoing, increases in the price level, which is what inflation's about, it's not clear to me that they'll do that. It may affect the transition path of getting back to 2%. And it may mean that we have to, really focus in on that and keep interest rates at a higher level but remember, before the pandemic, there were a lot of things weighing on inflation on the downside, right? It wasn't until late in that 10-year plus expansion that we got inflation up to 2%. So this will be very interesting. Once we get back down to 2%, it'll be very interesting about what those interplays are. But there are going to be pressures on the downside and pressures on the upside. And some of them, the structural factors that you just named, maybe pressures on the upside, but there are probably those pressures that were leading us to have low inflation before the pandemic will probably reassert themselves as well.
Right. Things like automation, for example.
Exactly.
Yep. So a more technical question. This is from Barry from CEE.
Hi, Barry.
And he was looking for your view on mortgage-backed securities. So when we talk about the balance sheet runoff, we have treasuries on the balance sheet. We also have mortgage-backed securities. And how are you thinking about which of these vehicles, what pace you want to be selling?
Right. So basically, we've set up a plan that allows runoff up to caps, right? In September, the caps, maxed out. The treasuries are going to run off sooner because they're shorter maturity than the mortgage-backed securities are. At some point, if you go back to the March FOMC meeting and look at the minutes, there was a discussion about, well, once this balance sheet process is well underway, we should consider, or we would consider whether we should sell some of the mortgage-backed securities and rather than just letting them passively roll off. And the reason that I think is, I think that's something definitely worth considering is because we want to get back to a balance sheet that is primarily treasury securities, because we don't want to be in the credit allocation business, right? We basically want to hold a broad portfolio of treasuries, so we're not choosing which sectors that we're in holding. And so, given how long it takes for those mortgage-backed securities to roll off, given their maturity dates, selling some of that portfolio probably would be a good thing in my view. But we haven't made a decision about that, and we'll have to talk about the costs and benefits of doing so. But as of the March meeting, right, there was a general consensus that people thought that that would be something that we would consider at a later date.
Great. And while we're on Loretta, mortgages, one of the sectors in the U.S. economy that's definitely slowing rapidly as mortgage rates have gone up is the housing sector, which obviously is a critical part of the economy and one of the main transmission channels for monetary policy. Housing slowing could help slow the broader economy. You still have that strong labor market. People have incomes. They're still spending. You're seeing it in the PCE reports. You're seeing it in retail sales reports. Any thoughts from you? I know we have the median expectations from the Fed on the possible timing, severity of a recession. This is a question that's come up from a couple different people, so I just tried to pull it all together into one. Well, housing is a big part of the inflation that's going on right now. Shelter costs, they're a third of the CPI. So that's true that's one of the persistent parts of the inflation measures. And rents are still quite high. Rents for new houses are still, or apartments are still very, very high, and increasing at a high pace and increasing more than rents that are already, out there. So again, that's going to keep inflation up for a while. You're right, the increases in interest rates have fed through to mortgage rates, which has slowed the housing market, but that's one of the equilibrating things that's going to go on in terms of slowing the economy. So again, right, that's going to be one of the things that slows, and other interest rate sectors will slow as well, but that's going to help bring supply and demand back in line and get this inflation down. So that's one of the sectors that's going to show the effects soonest, and we're already seeing that. Again, that process will continue. The good thing, though, is that, if you think back, people are right to be nervous about this because they're thinking back to the financial crisis where it all worked through the housing market. What's different now is that the kinds of mortgages that were made back then, and the credit risks around them and the banks not being healthy, we don't have that now. Right. So again, the financial side of things is much more healthy. Household balance sheets are much more healthy. And so we're going to see this action, but it's not going to be as have the same kind of problems that we saw during the financial crisis. Great. Thank you. One question we've gotten on money supply. And I have read quite a lot of research recently talking about the rise that we had seen in money supply, and now it's on a change basis, it's coming down very, very quickly. Do you see that as a leading indicator for inflation? How does the Fed think about money supply in connection with inflation these days?
Yeah, I mean, it hasn't been that reliable an indicator one way or the other. I mean, so again, that's not one of the key things I look at, but it is correlated really with the economy. So you can't throw it away totally, but it hasn't been a very reliable indicator of where inflation currently is or where it's going. So I don't look at that as that helpful in terms of understanding where the economy is going and where inflation is going in particular, because that's where my focus is really right now.
A couple questions on fiscal policy that are coming through the chat. And, again, I don't want to dwell on the UK right now, but it does seem like the recent bout of volatility was the catalyst, was the fiscal easing that was announced. Do you think the Fed can get to its 2% target just with the balance sheet and rates? Do you need restrictive fiscal policy also? It does feel like in the pandemic, the Fed moved fast and big, right? We got a big reaction. We got a fast reaction, not just with direct monetary policy, but a lot of liquidity facilities and other things to try to help the economy. But at the end of the day, we still needed that fiscal stimulus to avoid a deeper and more prolonged recession. Is the reverse true? Do you need restrictive fiscal now more so than what we have today to get to your target, do you think?
No, we'll get to our target using our interest rate tools. So I'm not, we take fiscal policy, as part of the economic environment in which we're setting policy, and we know that, we take that into account when we're trying to forecast where the economy is going. Obviously, right, it was very supportive of households and businesses during the pandemic, and balance sheets still have. They haven't spent that down yet. And so that is part of the environment in which we're trying to, get back to 2% inflation. So we do take that into account, but we're going to use our tools to get back to 2% inflation. There's different things affecting those inflation rates. You think about war in Ukraine, right? And what will happen to energy prices, that will feed into the inflation measure. So there's a lot of external things that are affecting inflation, but we're going to use our tools to get inflation back down, and we'll just keep at it until we do so.
Great. I think we have time for maybe one or two more questions. One question that came in is on timing. So historically, we were all taught that monetary policy feeds through the economy with a lag, and people would reference often, 12 months-ish. Do you think, do you think there is a time frame that you think about that makes sense? And has it changed over time? Is the economy moving more quickly or more slowly for different reasons than it did in the past? For everyone on this call thinking about, okay, what should I expect as the picture unfolds? What sort of lag would you think is reasonable today, and has it changed?
Yeah. Well, I mean, one of the things that you saw at the end of last year when the Fed started communicating that we were going to be starting to take back the accommodation is you did see financial markets react quite strongly to even before we actually made the first rate increase. So in that sense, it did seem to feed through the financial markets pretty quickly in terms of what we say we were going to do. And then, of course, we ratified that by what we are doing now. I think, long and variable lags still apply, but we still need to do more because it has fed through, and yet we still have inflation being very high. If you look at, again, the Fed projections, it takes a while to get inflation down given the level it's at. So my own forecast is that inflation won't get back to 2% for another couple of years, but that doesn't mean it's not coming down. It's coming down pretty well next year, still above our goal, and then continuing to move down the subsequent year. So again, it's going to take a while to get this inflation down because it's at a level that's high, very high, and it's very persistent. But that's why the Fed, will have its interest rate up at a level and keep it there. And my presumption is that we will not be cutting rates next year at all. We'll continue to raise them early next year and then hold them, because that's what's it's going to take to get inflation down.
Yeah, and not a question, it's a comment from me in the peanut gallery. It is amazing to me that even with the commentary, you and others at the Fed, you're extremely clear. They're going to go up and hold, but you still see markets discounting that the Fed is going to start easing next year.
Yeah.
And I don't know how much you guys have to talk before that pricing changes. It feels like the market is convinced that you will be forced to pivot no matter what you say.
Well, that's the market perception. And, we just have to be clearly communicating as best we can what our intentions are. It's also probably reflective of where they see the economy going versus where we see the economy going and where our expectations are for inflation. I think, what I keep saying is we can't let wishful thinking drive our policy decisions. It has to be compelling evidence. So again, I welcome, the compelling evidence I'm looking for that inflation is moving back down. We have seen some moderation on the demand side, but so far that moderation hasn't worked on the inflation yet. And we just have to keep at it until it does.
Thank you. I'm looking through the questions to see if we've missed anything. We did, maybe my final question here. We had one interesting question on energy prices. Obviously, we've had a huge amount of volatility in energy prices for the US consumer. Gasoline prices, a big deal. Now that OPEC has announced this week, it's going to cut supply 2 million barrels a day, I believe. And that was more than was expected. We're seeing oil prices up, gasoline prices up a little bit. The US added supply through strategic petroleum reserves is running off. Obviously, you're looking at core inflation. You're not ignoring the food and the energy prices. They're important. But when energy prices are moving around like this, and clearly they are having such a big impact, is there anything the Fed can do or tries to do to get energy prices down?
Well, our goal is total PC inflation, which includes food and energy. And food and energy are really important for people, right? It's people don't just spend on the core inflation components, they spend on food and energy. So it is very important. It's not that we ignore it. The reason that you focus on core inflation is it gives you a better read of where inflation's going, that underlying path. But food and energy are really important. Gasoline prices are really important because it really burdens households. And I focus on them quite a bit because what we have seen in the research that we do here is that inflation expectations really are affected by the gasoline prices and the food prices that people are actually paying. And again, if inflation expectations get out of hand, that's just going to make this a much harder and more costly process. So I do think that we have to focus on those components and not ignore them, and really feed that into our policy decisions to make sure that inflation expectations remain anchored and we can get inflation back down sustainably to 2%.
Well, Loretta, I know we're almost at time, so I'm going to wrap up here, and I think Nan's going to make some closing remarks. But first, I would like to thank you for a really great conversation. And I think about inflation expectations in the US, and I'm so grateful, frankly. If we hadn't had the credibility of the Fed and the focus of the Fed over the last decades, we'd be in a much tougher place today than we are. It has been amazing how much inflation expectations have stayed anchored, given what spot inflation has been doing. Kudos to the Fed for helping to make that happen. So I think that is something really great to recognize, and it does feed through to the whole economy and help people who are on this call. But thank you for your time. Thank you for being so generous with it, for your support of the Council for Economic Education. And thank you to everyone here today for all your questions. I hope we addressed almost all of them, if not all of them. And Nan, with that, can I turn it back over to you to close us out?
Thank you. I'll just pile on the thank yous to Loretta, and also thank you, Rebecca, who appeared from a last-minute business trip and figured out how to make it work for us. We are so fortunate to have both of you in our orbits, your brilliance, and also your great advocacy for our mission. And if anybody out there would like to know more about our mission to bring personal finance and K-12 education to all kids K-12, so they can have that tools and knowledge to create better lives for themselves, their families, and their communities, my team and I are delighted to chat. We also have our Champions of Financial Literacy breakfast coming up in Boston in early November. And would be delighted to talk to you about that. And our New York Women's Breakfast will happen in December, where Rebecca will also be hosting a panel for us. So thank you all for joining us this evening, again, to our hosts and to my many board and staff members who were watching us tonight, as well as to many of our wonderful affiliates, donors, and some educators as well. Thanks. Have a great rest of the fall, and we'll see you in another month or so.
Thank you.
Thank
Good night.
you. Appreciate it.